time to join in. So please just wait for next few minutes and we'll begin. Hi everyone, good morning. You're all welcome to Details webinar, and I hope everyone here is looking forward to gaining knowledge and useful tips during the webinar today. My name is Timlua Shutoma, and I'm a solicitor at Detail. I have the honor of kickstarting this webinar. In the next few minutes, I'll be speaking about Detail and introducing the panelists for the webinar. Detail Commercial Solicitors is Nigeria's first commercial law firm which specializes exclusively in non-courtroom transactions. We pride ourselves, not to sound cliche, but in being detailed and flexible towards the needs and demands of our clients. We have several practice areas, which are energy, power and infrastructure, finance and capital markets, corporate and commercial, real estate and construction practice areas. We also have the legal tax advisory practice area and technology and digital economy practice area, which are probably behind today's webinar. One of our core values at Detail here is thought leadership. And we achieve this by evolving as the commercial space within and outside Nigeria grows. This has birthed the creation of our webinar series. The goal for each webinar is to create a platform where industry experts can analyze topical issues that affect businesses and the economy. As you must have seen in our flyers and other publicity mediums, the theme for this webinar is Taxation of the Digital Economy, which will be discussed by our brilliant panelists. Moving on to our panelists today, we have Akinwale Alao from KPMG, who will be giving us great insights on the theme from a pure taxation perspective. Akinwale Alao is an associate director in KPMG with over 13 years Nigerian and international tax experience. He's an alumnus of the Lagos Business School and a member of the Institute of Chartered Accountants of Nigeria and the Chartered Institute of Taxation of Nigeria. Akinwale has in-depth knowledge of all tax laws in Nigeria and has extensive experience in providing tax advice to multinationals and indigenous clients in disparate industries, including the information and communications technology, shipping, aviation, hospitality, pharmaceutical, fast-moving and consumer goods, agriculture, construction, power, and oil and gas sectors. He has advised multinational companies such as Apple, Microsoft, Amazon, Bloomberg, SES Satellites, and Shopify on issues relating to the taxation of the digital economy in Nigeria. We also have on our panel Titilayo Akinsheye from InterSwitch, a reputable organization in the digital value chain. Titilayo Akinsheye is the manager in charge of the tax affairs of InterSwitch Limited and its subsidiaries, ensuring tax compliance and resolution of tax audits with the various tax authorities. She has over 13 years working experience and started her career with KPMG Professional Services. Titilayo holds an accounting degree from Covenant University. She's a member of the Institute of Chartered Accountants of Nigeria and the Chartered Institute of Taxation of Nigeria as a chartered accountant and a tax practitioner, respectively. She holds a Green Belt certification in Lean Six Sigma. Her skills include leading a fantastic team, establishing impeccable interpersonal skills, and providing excellent customer service, among others, all of which has contributed to her success as a tax expert. Our third speaker for today is a senior associate here at Detail, Anthony Iziamama. Anthony is a core member of the firm's energy, power, and infrastructure and legal tax advisory practice areas. In relation to the firm's legal tax advisory practice, Anthony possesses extensive knowledge of Nigeria's taxation legal regime and provides services to clients in terms of tax advisory support, contract structuring to mitigate avoidable tax exposures, tax negotiations, engagement with the tax authorities on clients' behalf, and tax planning and compliance. Anthony's experience in the tax space includes advising foreign and Nigerian clients in different sectors of the economy. We have clients such as fintech companies, upstream, midstream, and downstream oil and gas companies, real estate investment companies, and private equity companies on how tax affects their businesses. For hobbies, Anthony is also an avid lover of chess and looks forward to competing in world chess tournaments. Complementing our panel today is our moderator, who is the quintessential Chukwudi Ofili. Chukwudi is the recipient of the Nigerian Rising Star Award as one of the top 40 Nigerian lawyers under the age of 40 at the Nigerian Legal Award 2019, a feat he achieved while under the age of 30, and was featured as Africa's top legal millennial by the People's Accolade Law magazine in 2021. He's an associate partner at Detail and leads the technology and digital economic practice area, as well as the legal tax advisory practice area. He's qualified to practice law in Nigeria and in the state of New York. He's a first-class graduate of Babcock University and a full scholarship recipient from the University of Georgia School of Law, USA, where he obtained his LLM. He is also the current secretary of the Taxation Committee of the Nigerian Bar Association section on business law. Judy enjoys watching football, cycling, and watching movies. So just before I hand over to Judy to commence the panel session today, please note that you can send in questions through the Q&A icon just at the lower part of your screen, as we would have a Q&A session after the panel discussion. Once again, thank you for joining us today on our webinar. Over to you, Judy.
Okay, thank you. Thank you very much, Temi Lulua. Good morning, everybody, and welcome to the detailed webinar series on taxation of the digital economy. To kick off the webinar, I will just be making a presentation which essentially gives us a background to the conversation that we'll be having today and what we'll be hearing from the speakers and panelists. Okay, so essentially this webinar has been necessitated by an increasing shift in focus to online services and products. As you would agree with me, the traditional ways of doing business have changed. People no longer have to be physically present in various jurisdictions where they want to carry on business in the form of providing services and selling their products. So with this change in the way people carry on their business comes a consideration amongst nations on how profits that these companies make would be taxed. According to the World Bank, the digital economy accounts for about 15.5% of the global GDP, and over the past 15 years, it is growing at a 2.5 times rate to global GDP. In 2018, the Nigerian Investment Promotion Commission explained that the Nigerian digital economy is expected to generate about $88 billion and create 3 million new jobs by the end of 2021. This puts in perspective the rate at which we expect technology companies and digital services to grow worldwide and then in Nigeria. Interestingly, the COVID-19 pandemic has resulted in the reliance on online technology. There's now a substantial increase in digital activities and significant revenue earnings from companies operating digitally or in the e-commerce space. Interestingly as well, going to the US in 2020, Amazon, for instance, had a 38% increase in revenue, while Netflix recorded 37 million new subscribers. Such an increase in the activities in the digital space is expected to translate to more revenue, more profits, and ultimately more tax obligations. However, with this good news comes, certain challenges. One of these challenges is with the difficulty of countries establishing taxing rights over the profits of these multinational enterprises which operate in their jurisdictions, albeit without having any physical presence. Interestingly, under the rules of international taxation, taxing rights are allocated only to countries in which the non-resident entities have created significant physical presence. So essentially, there must be a nexus between services being provided and the presence of these entities in these jurisdictions for taxing rights to be exercised, right? Because of this challenge, the Organization for Economic Cooperation and Development, the OECD, in 2015, addressed the taxation of digital economy in its Action Plan 1, which is the Base Erosion and Profit Shifting Project, the BEPS. According to the OECD, the digital economy does not pose any special threats. However, it may increase the BEPS risks that we just talked about, right? So this is one of the challenges that the OECD identified. The pillar 1 of the project seeks to endorse a unified approach, right? This approach is designed to adapt countries' taxing rights to take into account new business models and essentially relocate taxing rights in favor of the user stroke market country. The pillar 2, on the other hand, focuses on global anti-base erosion, essentially to ensure that countries tax profits at a minimum rate, which would ordinarily have gone untaxed or which would have been taxed at a lower rate. Right? So essentially, what you're looking to do, and what is sought to be achieved here is to use a global tax rate to see if this introduce some level of certainty and then helps countries capture profits being made by these MNEs. Driving it down to Africa, the African Tax Administration Forum has proposed a digital services tax framework and content for legislation in individual African countries. The DST framework will essentially, ensure that tax is levied in addition to income tax on the supply of certain specified services and charged at a fixed rate. There's no doubt that conversations are being had all over the world with respect to the digital economy. Beyond tax, even in terms of regulation, right? There's a lot of conversation around regulating most of the most of the innovations that we have within the tech ecosystem. So generally, it appears that regulations, laws are somewhat behind, and as we all know, innovation is on a fast rise. It's quicker than how fast we're able to come up with regulations. Same in the tax space. However, whilst countries are waiting for the OECD to come up with a comprehensive model, a lot of countries have set up unilateral frameworks to sort of capture the digital economy. For example, Tunisia has a 3% tax on gross income from the sale of computer applications and digital services. This started in 2020. Kenya also introduced a 1.5% tax on income earned through a digital market space with effect from January 2021. So as you can see, a lot of countries are beginning to take steps individually, right? Whilst they wait for the OECD or a more unified approach. And the objective here is to, as much as is possible, capture as much as they can. Whether it's not sufficient, they'll rather have something in the bucket first before something comprehensive comes out. Just a few quick facts to put taxation of digital economy in context. Recently, Saturday, the G7 nations reached a deal to increase taxing on Google, Amazon, Facebook, and Twitter, right? And a lot of people see this as a landmark deal against big tech companies. Notwithstanding the views held by different people, like different schools of thought, the key thing here is that digital and big tech companies have now realized that their tax obligations, they would have more tax obligations, right? A lot of countries are beginning to take a lot of interest in big tech and their business models. So it's becoming increasingly important for tech companies to understand the tax legislations that would apply to them across jurisdictions in which they provide these services. And then the concept of having tax havens or the importance of having, or the advantages of having tax havens are gradually being diminished with steps taken such as these. So coming down to Nigeria, so Nigeria has taken its own its own initiative to sort of capture the, the digital economy. The Finance Act 2019 expanded the conditions under which the business income of NRCs will be taxable in Nigeria. Under the new rules, non-resident companies will be liable to tax in Nigeria if one, they supply digital services or goods, and profits can be attributable to the activities, or they provide technical management, professional or consultancy services. And the second condition is if they have a significant economic presence in Nigeria. At the time the Finance Act was passed, the concept of what would amount to significant economic presence was not defined. So subsequently, the Minister of Finance, Budget and National Planning issued the company's income tax significant economic presence order to complement the provisions of the 2019 Finance Act. A definition which is key in that order is, what would be considered as digital service providers. Digital service providers are non-resident companies whose activities involve streaming or downloading services of digital contents. They transmit data collected about Nigerian users generated from users' activities. It would also include activities on websites or mobile applications, provision of goods or services through digital platform, or provision of intermediation services through digital platforms, websites, or other online applications. And a non-resident digital service provider will meet the significant economic presence threshold in Nigeria subject to certain requirements. Some of these requirements are what we've taken some time out to list. One of them is that it must derive a gross turnover or income in excess of 25 million in a given year from any or a combination of the activities listed in the SEP order. Interestingly, this 25 million threshold would also take into account activities carried on by the NRC's connected persons during the accounting year, or it uses a Nigerian domain name or registers a website in Nigeria. Another requirement is that it has a purposeful and sustained interaction with persons in Nigeria by customizing its platform to target persons in Nigeria. So with these new introductions by the Finance Act 2019, a digital non-resident company would typically be taxed at 30% of its taxable profits as company's income tax on specified activities. And in some instances where it derives up to 25 million turnover, like we've said, a service non-resident company would typically only have a withholding tax obligation, and that will be charged at the rate of 10% on the income derived from Nigeria. A key issue to note with the SCP order, which I know the panelists will discuss extensively, is that the SCP order provides that if Nigeria has entered into or enters into any multilateral agreement or a double taxation treaty to address tax challenges arising from digitalization of the economy, provisions of that agreement or arrangements will apply and effectively override the provisions of the SCP order with respect to any NRC that is covered by that agreement. Similarly, same for NRCs that are from countries with which Nigeria has a DTA. So this throws up many issues, right, from the SCP order, which the panelists will discuss. So we'll be talking about the SCP order versus these multilateral agreements and DTTs. A key question would be, how do you attribute the actual profit that belongs to the NRC as a result of this SCP in Nigeria, right? Because of the nature of these services and how payments are made, how would the FIRS, for example, determine what portion is derived, from Nigeria? A portion of the profits is derived from Nigeria. Another key question is how the FIRS would enforce and ensure compliance on these NRCs who, remember, um, may not have any physical presence in Nigeria. And, the FIS does not have any regulatory oversight over these NRCs. Um, a number of these would be discussed by the panelists, and it makes for an interesting conversation. Beyond these conversations, we'll also be talking about the current tax regime for tech companies in Nigeria. And we know that a lot of people who are listening in are startups and people who are actively engaged in the tech ecosystem. So just to set the tone for the conversation, right? Considering that the taxing rules on the digital economy are subject to change from time to time, it's important that tax authorities and then taxpayers and players in the ecosystem must continue to continually increase human capacity on tax-related matters. Then the key question for us, as panelists, would be: what's the way forward for Nigerian digital service providers, and what is the way forward for NRCs who provide services in Nigeria and meet the requirements under the SAP order? With this background, I think that this is a good point for us to, engage the panelists and, hear from them. So I'd like to welcome Akinwale, Titilayo, and Anthony. So I'll be asking questions. The questions I'll be asking in no particular order. But I would like to start. I would like to start from Akinwale. Akinwale, in your experience advising companies within the tech and digital sector, can you please just tell us how companies in this sector are currently taxed in Nigeria? And I guess specific taxes that are targeted to tech companies or companies that operate in the digital space.
Okay, thanks, Trudy. And good morning, everyone. Companies that are operating in the digital sector are generally taxed under the same overarching framework for the taxation of companies in Nigeria. There's no special tax law per se for them, but you've already touched on some of the provisions of the tax regimes that apply to companies operating in the digital sector. So I would just say that broadly speaking, the framework comprises direct taxes and indirect taxes. For direct taxes, the major one is the company's income tax. You already touched on that. So there is a provision of the Companies Income Tax Act that really covers taxation of companies. So it talks about the fact that if a company is a Nigerian company, the company will be taxable on its global profits. So wherever the profits are derived from, those profits will still be taxable in Nigeria. So if you have a Nigerian company that's in the digital space, that company will be taxable on the profits it derives from Nigeria and the profits it derives from other jurisdictions outside Nigeria. However, if the company operating in the digital space is a non-resident company, it's a foreign company, then that company would only be taxable in Nigeria to the extent that it has a taxable presence in Nigeria. Now, historically, the basis for determining whether a company has a taxable presence in Nigeria has largely been based on the company having a physical presence in Nigeria. But like you mentioned in your introduction, there have been the introduction of the Finance Act 2019 that amended certain sections of the Companies Income Tax Act and also required the Minister of Finance to issue an order. You already touched on the fact that a significant economic presence order was issued by the Minister of Finance, Budget and Planning in 2020. And based on that order, non-resident companies that are operating in the digital space, even though they don't have a physical presence in Nigeria, they may be liable to tax in Nigeria if they meet the conditions specified. So, for instance, if they have a sustained interaction with persons in Nigeria, they have customers in Nigeria, then those companies may be taxable in Nigeria, even if they don't have any physical presence, no office, no employees in Nigeria. So to that extent, there's some form of special regime by way of the significant economic presence order. So that's the main one regarding direct taxes. The major one regarding indirect taxes is the update that has been made to the Value Added Tax Act in Nigeria, under which the consideration for whether a company is liable to value added tax in Nigeria or needs to register for value added tax purposes in Nigeria is no longer whether it's carrying on business in Nigeria. It is now, for instance, if it's a service provider, whether it is providing services to Nigeria. And that the act, the VAT Act was amended in such a way that once a company has customers in Nigeria or has consumers of its service in Nigeria, that company would be seen as providing service to Nigeria, and that company would then have an obligation to register for value-added tax purposes in Nigeria. So those are the major updates. So just to summarize, companies that are operating in the digital space, they are liable to companies' income tax, but the way they are taxed, if they are foreign companies, would be based on the Companies Income Tax Act itself, and the provisions of the Significant Economic Presence Order. And then companies that are in the digital space would also be liable to value-added tax, so they would need to register for value-added tax purposes in Nigeria, whether once they operate in Nigeria or if they have customers in Nigeria. So that will be my response to your question. Thanks, Judy.
Okay, thank you very much, Akinwa.
Hi, Judy. I think there's a network glitch from Judy's end. I'm sure it will be resolved shortly. I think maybe pending when we have Judy back, maybe what I can also just add to the comments I've made with respect to the taxation of companies operating in the digital space is that those companies also need to be aware. So Nigerian companies, for instance, that are dealing with multinational companies operating in digital space need to be aware of the fact that they also have obligations. So when a Nigerian company, a tech company, for instance, is dealing with the likes of maybe Facebook in terms of advertisement, dealing with the likes of Microsoft, maybe in terms of cloud storage and things like that, because those companies would most likely have a significant economic presence in Nigeria, what that implies is that the Nigerian tech companies would have an obligation to deduct withholding tax from payments to the foreign companies. So Nigerian companies operating in the digital space need to be aware of that when you are making payments to a foreign company operating in the digital space, you need to evaluate whether that foreign company has a significant economic presence in Nigeria. And if it does, then that means the Nigerian company has an obligation to deduct withholding tax from payments to the foreign company. Otherwise, the tax authorities in Nigeria may hold the Nigerian company responsible for the non-deduction of withholding tax from those payments. And there may also be penalty and interest charges in that regard. I think the other thing to note is that when foreign companies provide service to Nigerian companies, the Nigerian customer or the Nigerian business is the one enjoying the service, and so it is the Nigerian company that is liable to the value-added tax due. So whether or not the foreign company charges value-added tax on the services that are provided to the Nigerian tech company, the Nigerian tech company has an obligation to account for the value-added tax. So Nigerian tech companies need to be aware of that obligation as well. When you do business with foreign tech companies, whether or not they charge value-added tax, VAT is applicable on those services, and the Nigerian company then needs to self-account for the VAT and remit it to the Federal Inland Revenue Service. So I think those are important points with respect to the taxation of the digital space in Nigeria that Nigerian companies need to be aware of.
Thank you, Akinwale. Sorry, my colleague will join soon. I think he's having a slight internet issue. But just lending my voice to what you just said. I think the basis for taxation of companies in the digital space is pretty much the same with what is obtainable in other sectors. I think the key focus here is more the changes brought about by the Finance Act, amending Section 13.2 of CETA and the relevant provisions of the value-added tax, and even in fact, the Stamp Duties Act with respect to electronic stamping and all those stuff. So the legal regime still much the same, subject to some of these amendments, well, which I would say that are quite far-reaching.
Okay, so maybe pending when Trudy joins, in addition to what has been said, is that I think aside the existing tax regime for taxing regular companies or whether you're a tech company in Nigeria, is I think the main issue is how is the FRS expected to, get into the Nigerian tax net? Trudy is back. Let me just conclude. So how is the FRS expected to get into the tax net? Those tech companies that you just go on their site and pay for services. So sometimes they might necessarily not invoice you. So I go on, for instance, Amazon, and I need their service. They might not send me an invoice. I just use my card to make payments. So there are a lot of things, that are missing with respect to getting tech companies, especially non-residents, into the Nigerian tax space. So there's a lot of work to be done by the tax authorities and regulators in that aspect. So over to you, Judy.
Thank you, Titilayo, for stepping in when we had technical difficulties. So, I mean, from the point of view of an industry player, someone who actively participates in the tech ecosystem, what impact have the recent changes to the Nigerian tax laws had on your business model? And was InterSwitch prepared for this change? If you were prepared, what advice would you give to companies within the digital space with respect to tax planning and tax structuring?
Okay, thank you. So obviously the impact to the relevant changes increased level of compliance from our own end as the business. So obviously increasing the cost of doing business because things were not pre-planned. So at the point when the Finance Act 2019 was enacted, there were a lot of engagements that needed to be had with several vendors, and considering the nature of the business we run, we obviously have a lot of foreign companies that we deal with. And you have them back and forth on trying to let them know that there are changes to the Nigerian tax legislation, and this is what you need to do. There are penalties for not doing it. And we do not want to run foul of the law as a fully compliant company that we have. So there was increased, obviously, engagement with our vendors. And so for some contracts that were signed prior to the Finance Act and were running, so you have certain vendors telling you at the point when I signed the agreement, this was it. This is the clause, the tax clause that was there. It was not in place and all that. So in effect, it tends to affect the bottom line because your margin is then reduced because you then have to factor in whatever tax element you're expected to remit to the tax authority. Now, with respect to how prepared we are, at the point when the finance bill, was being reviewed and consulting firms were reviewing it as well. So we were abreast of the proposed changes. And so what we had done in-house was to start discussing the impact it would have on our business. And then what do we need from a system change perspective. So we're prepared for that change. So at the point when it was enacted, all we had to do was then, go to the system and, ensure that the necessary change, has been put in place. And so we kicked off the aspect of the VAT. The portion of withholding tax from foreign vendors is obviously an ongoing discussions whereby we have back and forth with customers on board. At least we are getting an headway with that. Now, with respect to what steps should a startup tech company take. So it's important that whether as a Nigerian startup or as a foreign startup with a focus in Nigeria or Africa as a whole, what structure do you really want to take? And I think it's critical that as a startup, from the beginning, you engage specialists, the consultants, the lawyers, because you can't, a lot of companies, I hear a lot of companies saying, oh, I searched the internet and this is it. So there are a lot of materials just dumped on the internet, but then it's when you engage the specialists in this role, they're able to guide you on existing law and even propose changes that are not yet made public based on their engagement with the government. And then of importance also is when that is done, right, it enables you stand on a very good ground and you're able to run your business without, ensuring that there is no reputational risk. Because as a startup looking forward to future that there are foreign investors that are looking to bring into your business to boost your business, you do not want any reputational risk. So it's important that things are done rightly and correctly at the beginning. Thank you.
Okay, thank you very much, Titilayo. So I'll just move over to Anthony. Just on the back of what Titilayo has just said to us, in your experience as a legal tax practitioner, what factors should tech startups and tech companies generally consider in their tax structuring attempts or initiatives? Particularly because as much as it's possible, right, as a startup, you do not want to be burdened by taxes, right? So what do you typically advise startups to do as a tech and tax lawyer?
Okay, thank you very much. I'll start by saying that, of course, every tech company should take its tax compliance issues seriously, right? And you should have a checklist of what taxes should apply to my business. So, of course, as my colleague and friend Akinwale has said earlier, you have to consider the issues of companies' income tax application to your business. the withholding tax element to it, and what services are you providing, or what services will you consume. That will also help you to identify the relevant tax rates, right? Then, of course, stamp duties implications when you enter into formal contracts, value-added tax applications, personal income tax obligations. So the full gamut of the tax laws should be taken into consideration in setting up my business. I don't know whether this is too early to then talk about some of the structuring issues we have seen and ways to mitigate exposures, especially when you are dealing with when the person is a non-resident company, right? So I based on the amendment by the Finance Act to Section 13(2) of the Companies Income Tax Act, which introduces the digital taxation, right? The digital services and goods taxation. It seems to reason that that provision specifically applies to players that come from a non-double taxation treaty country, right? Where that entity comes from a DTA country, then you have to go back to the relevant provisions of the double taxation treaties, right? And by strictly speaking from the point of law, Section 45 of the Companies Income Tax Act gives the double taxation treaty priority over the Nigerian tax law. So that where there is a conflict between them, the DTA should override. The implication of that is that the DTA, as currently structured, seems to recognize or tax based on the basis of physical presence, right? So
yes,
it appears, sorry, can you hear me?
Yes, I can hear you. Proceed, please.
Okay. It appears that from a tax structuring perspective, a fintech or companies in that space that wants to do business in Nigeria they will seem to like do transactions with countries that has DTA with Nigeria, right? So in order to mitigate or to reduce their tax exposure.
Okay, let me go back to Titilayo. I know that there are two schools of thought on this issue. The DTAs versus the companies, the SCP order, right? So your school of thought is that where it deals with NRCs from DTA countries, the DTA will trump the SCP order, right? There's another school of thought which I know Titilayo belongs to, which is that's not the case. It doesn't trump it. So let's hear. I know actually you've done a legal analysis, but let's hear from someone who is, an industry, participant. Let's hear her view with respect to this issue on SCP versus DTT.
All right, thanks. So at the point when the Finance Act, and the SCP order was issued, there were obviously concerns as discussions are ongoing with all parties on, so what should we do? We say so excluding countries that you have DTA with. And so the thing is, if you refer to the DTTs that we have, these DTTs have been in existence for so many years. And if you look at it, so my own view is, as the government, makes changes to certain sections of the law, and I think it's a nice approach now that, as the budget is passed, we have several, we have a Finance Act that is amending certain sections of the law. So our tax law, needs to be rejigged and revamped. So when certain sections of the law are amended, my own position, and also discussing with some people at the FRS, was you need to then consider the current realities. And what is the current realities? Because taxing the digital economy, it's a global issue. So what do we do? when we're discussing and saying, okay, a lot of people also reached out to say, oh, I'm based in UK, I need to go back to the DTA, and I'm like, okay, this is what the order says. But when the tax authorities come, who will bear the brunt of not deducting, knowing fully well that the way reporting is not, I'm not isolating to say, oh, this expense was actually, paid over to certain vendors in certain jurisdictions and all that. From my interactions with a couple of people at the FRS at that time, their position was deduct, because at least for a UK entity, they can still get a relief, and I have a couple of vendors that have gotten that relief as a result of deductions we had made sometime in early 2020s. So that's what I've actually pushed for, because until when the government goes back and revisits the DTTs, I will continue to deduct, because doing audits, interacting with the tax authorities, this conversation does not come up at all. Even though the law is saying, oh, excluding them, DTT would supersede the SCP order, but I think we need to follow the current realities of where we are today.
So interestingly, thank you very much. Interesting, Titilayo. And this issue with respect to what the FIRS views so how the FIRS views some of these amendments, these what the legal position has always been an issue, right? Across many issues. Just to touch base on one of these issues is with respect to exported services and NRCs, right? The Finance Act made certain amendments to the VAT regime. Subsequent to the Finance Act, the FIRS issued a clarification circular, right, that deals with VAT. Within that circular, there are some clarifications with respect to exported services and which exported services should not be subject to VAT, right? These exported services will be services that are provided to NRCs outside, so from Nigeria, but consumed outside of Nigeria, right? There are a number of conditions that must be met for that exemption to apply, such that VAT will not apply. One of such requirements is that the NRC should not have a permanent establishment or fixed base in Nigeria, one, and that the party that enjoys the services, that consumes the services or the service, right, must be the foreign entity. That's the entity outside of Nigeria. So the consumption must be done outside of Nigeria, right? I would just ask Anthony. So Anthony, from a legal perspective, right, and your experience with the FIRS, what's the FIRS's position, in terms of interpreting that clarification practically, and then the position of these NRCs who sometimes have some sort of physical presence, but they argue that this physical presence does not amount to a permanent establishment or a fixed base, and therefore should not suffer VAT on the services that are provided to them. I know the FIRS has a different position, but could you just take us through this dichotomy and difference? Yeah.
Okay, thank you very much. From our experience interacting with the tax authority as well as taxpayers, right, there seems to be a misalignment between both parties on the import of the exported services as defined in the Finance Act and as also clarified by FIRS in their value-added tax circular they issued sometime last year. So I think the key point of conflict between the FIRS and the taxpayers is in relation to that provision that says, provided that services provided to the fixed base or permanent establishment of a non-resident shall not be regarded as exported services, right? FIRS has taken the aggressive position to say that this is what we have seen from experience. to say that to the extent that you are a resident in Nigeria is providing services to someone offshore, right, with a local subsidiary in Nigeria, that the consumption is deemed to also, that services is deemed to also be consumed by the local subsidiary, so that that transaction will no longer qualify as exported services. This seems not to be on all fours with the law, right? Because I think the material point is who indeed consumed the services. To the extent that the services was consumed offshore, right, then value-added tax should not apply. You are going to have a very heated argument or back and forth with FIRS, trying to convince them that the services you are providing to a related entity offshore, in one way or the other, will not relate to the local entity which that foreign company has in Nigeria.
Okay, so Akinwale, welcome back. Just to piggyback off what Anthony has just said, so from a tax policy perspective, how does this inconsistency help with the ease of doing business in this case, certainty of what taxes apply to NRCs? If the provisions of the law appear to mean one thing or say one thing, and then the tax authority seems to interpret it, in another breath, there seems to be, issues around factual determination here. So, my first question is: do you see changes being made in this regard in subsequent laws or amendments to the tax laws? And two, from a tax policy perspective, how does this place Nigeria generally?
Okay, thanks, Judy. So regarding your first question, do I see changes being made in this regard? Well, I believe changes will be made in the future as there is further engagement with the tax authority. That's one area that taxpayers and tax advisors need to continue to work on. We need to continue to engage with the tax authority. We need to know that pronouncements of the Federal Inland Revenue Service do not have the force of law. To the extent that the provisions of the law are clear on an issue, it is okay for taxpayers to disagree with the FRS's position and to challenge the FRS's position, because it's in having that kind of debate that we can have a robust tax system in Nigeria. So I think there will be changes as long as taxpayers and tax advisors, tax practitioners generally engage further with the FIRS, draw the FIRS's attention to inconsistencies between its position and the law, and maybe in some cases even challenge the position at the tax appeal tribunal, because at the end of the day, tax laws, tax administration in Nigeria needs to be based on tax law provisions, and that needs to be very, very, very clearly understood by the FIRS. Now, with respect to where this places Nigeria or how this impacts Nigeria's ease of doing business, I think that it detracts from Nigeria's ability to improve its rankings on the ease of doing business index. As long as multinational enterprises see inconsistencies in Nigeria's position, see policy somersaults in Nigeria, not just from a tax point of view, but from a general business point of view, then it's going to increase the risk or the perceived risk of doing business in Nigeria. And these days, there's a lot of competition for foreign direct investment, and Nigeria has been doing poorly in the last few years. So we really need to look at these kind of areas to ensure that that we improve the level of consistency in the tax framework, the level of certainty, the level of clarity in our tax framework. We engage more with multinational enterprises, and that way, I think we can attract investment and continue to move forward as a country. Thank you.
Okay, Thank you, Akinwale. Just before you go, this time around, just to continue from what you said, right? It is clear that there are issues with taxation of the digital economy in Nigeria, right? But I dare say that these issues are not peculiar to Nigeria, right? I believe that some of these issues are being faced by other countries all over the world. So what would you say are some of the challenges that are being faced generally with respect to taxation of the digital economy, on the one hand? Then secondly, would you say that the SCP concept and SCP order has been successful in trying to bring, NRCs that provide services or products within the digital space within the tax nets of the Nigerian tax authorities?
Okay, thanks, Judy, for those questions. Maybe I should start with the second one and talk about what I think about the significant economic presence order and how effective it has been. And I would say it has not been very effective. It has not been very effective. What we find is that there is clarity to an extent about which revenues are liable to tax in Nigeria. But companies' income tax at the end of the day is not based on revenue, it is based on profits. And also, the question then is, how do you determine the profits of a foreign digital service provider? And that has been challenging. The company's income tax doesn't clearly state the framework for that. The significant economic presence order doesn't clearly state the framework for that. And there hasn't been guidance from the tax authority on that. The general transfer pricing framework doesn't also provide clarity on how to do that. So it's good that there's been some conversations. You talked earlier about the two-pillar approach, and at least with the G7 discussions that happened last week, I think there's some traction in that area. So I would say the significant economic presence approach has not been very successful because of the difficulty in having certainty on the determination of profits. And it is when you have the clarity on the determination of profits that you can then talk about, what will be taxed. The other reason why it has not been so successful is because it is, at the end of the day, it falls under the Companies Income Tax Act. And so the issue of double tax treaty then arises, because if you then have a digital service provider, a foreign digital service provider that is based in a foreign country that Nigeria has a double tax treaty with, then that company may end up still not being liable to companies' income tax in Nigeria based on the articles of the treaty. Articles 5, Article 7 of the double tax treaty are very clear about the basis for taxation of companies in respect of business profits. And so to a large extent, that then also affects the level of effectiveness of the significant economic presence regime. What other countries have done is to adopt a digital services tax approach, which is a separate tax type altogether. And if Nigeria had adopted that, then digital service providers will not be able to enjoy the treaty shield in not paying tax on the profits derived from Nigeria. And maybe, the base for most digital services tax is also revenue. So maybe 1.5% of revenue, maybe about 3% in other countries of revenue. That is clearer, and that is easier to implement. So I think those are the comments on the effectiveness of the significant economic presence regime in Nigeria. With respect to the first question that you asked about what are the things that have really impacted policy in this area, or what's affecting the effectiveness, I would say in Nigeria, one of the major issues is with respect to global buy-in. So for a long time, there's been this debate on Action 1 of the BEPS project, and it is only until recently that you can really say, at least from the G7 conversation, it looks like everybody is now on the same page as to the fact that digital service providers need to be taxed. But for a long time, that global buy-in has been an issue. And then the other one is about the weak level of enforcement of tax laws in Nigeria. Even domestically, I'm not aware of anybody that has been prosecuted for tax evasion, whether a company or an individual in Nigeria. So when businesses see that tax laws are not really enforced in Nigeria, then the appetite for compliance is reduced because okay, so what's going to happen if we don't comply? And that is the stance that many foreign companies are taking with respect to the significant economic presence regime in Nigeria. There are foreign companies that are aware of the provisions of the act, but they are reluctant to comply because of the lack of clarity, but also because, at the end of the day, what's going to happen? What's the worst that can happen? Will anyone go to jail for non-compliance? Maybe not. So that's something that needs to happen. Then the last point would be the need for the tax authority to continue to engage with multinational enterprises. That needs to be done if we want to see increased level of compliance. Thank you.
Thank you very much, Akinwale. Titilayo, I think this is a good point for me to ask you, having heard all of these challenges, right? Having heard issues with respect to how the FIS interprets certain provisions and what the law actually says, what the international community is thinking and the direction in which other countries are going. As someone who is both a local player and has a lot of international affiliations, and you have a lot of experience in the international tax space, what amendments or developments would you like to see as someone who is an industry player? And what changes would you like to see with respect to the digital sector and taxation?
Okay, so I think first, before one can recommend an amendment, is obviously what we require from the government or the regulators are increased collaboration with the industry to even understand, because I think it's a single line approach might not be applicable to a company A or B or C based on the nature of the services. So before talking of the amendments, the government needs to really understand, because what I see is we just take a feel of what is happening internationally and we try to tweak some things and say, okay, this is the easy one, and we go, and that's what has happened with the SCP order. But then is understanding the business and collaboration with the industry would bring a better amendment. Now, if you are a local fintech or digital company, there might be little to what you can do. But then is, as a startup or even a long existing digital company, what can the company do? Now, the pioneer incentive, it's more focused on your new business and all that. But the government is the CBN is talking about financial inclusion, cashless policy. What can we do? And the government cannot do this on their own. So businesses are the ones that would help government actualize plans, to fulfill all these policies that they are dreaming of. And so for me, I think a consideration of pioneer incentive for companies in this space is actually good, not necessarily for a startup, but then for a long existing company that is injecting capital. I might be injecting capital, not necessarily for a new product, but then I'm injecting capital for infrastructure, and it's going to boost my revenue, and in turn, also the government gets a tax revenue for that. I think a consideration needs to be made with respect to pioneer incentive for digital sector. And then for the requirements to withhold or to self-account for VAT. So if you say that the Nigerian beneficiary should self-account for the VAT, why then do you need a non-resident company to register for the VAT again? Because you really can't owe them to get that VAT. Who do you hold on to? It's the Nigerian company. So for me, I think that section should actually be be basically scrapped. Akinwale has talked about what the CIT says on tax is on profit, not necessarily on revenue. But today, the withholding tax is obviously on revenue. What if, and these tech companies can begin to have, financial statements in countries whereby they earn revenue, and they're telling you, if a lot of them then toe that line and they're preparing financial statements, they may be in a loss position. So what then happens to the 10% we've deducted on the revenue? So there are a lot of things that needs to be reviewed, and understanding the business, and maybe the forthcoming session also at the OECD in July might also draw perspective from the things that are happening. But then the Nigerian government actually needs to sit down and carve out specific rules guiding the digital sector. Thank you.
Thank you very much. Thank you very much, Titilayo. Anthony, as a legal tax practitioner, we've heard from Titilayo, who is an industry player. In what direction do you see the laws on taxation of the digital sector developing? Should we expect to see more laws? Should we expect to see more amendments? And in what areas should we expect to see these amendments? For sure, we are going to have another Finance Act that would accompany the appropriation bill for the next budget. So could you please just let us know some of these changes that you expect to see?
Okay. From where I sit, I would say I don't expect to see more laws. Rather, I expect to see more clarity, right? You have these laws here and there, right? But when it comes to the actual implementation or interpretation of those laws, that's where you will find issues, right? So what I expect to see from the government is more clarity with respect to these tax laws, right? I think that the significant economic presence taxation regime here in Nigeria is broad, right? But the issue I find there is with respect to the interpretation of the relevant provisions, especially as it relates to people that are residents of DTA countries. What is the position? Can you confidently say now that those people are captured under the current significant economic presence order? My view, right, will be no, right? They are not sufficiently covered. So if that is the case, why don't you clarify this, right? So I expect that the new Finance Act that should be coming on board should provide more clarity than more taxation. So that's what I think and my expectation.
Okay, thank you very much, Anthony. Akinwale, I will just come over to you now. I don't know if you can hear me.
Yes, I can.
Okay, fantastic. When we talk about the digital economy, digital space, and that the conversation is not complete without talking about what is, the main issue for most people, which is digital currencies, right? Cryptocurrency. At the moment, particularly in Nigeria and in most other countries of the world, cryptocurrencies and digital currencies are not currently regulated, right? Similarly, in terms of taxation, there aren't any tax laws or policies particularly directly targeted at cryptocurrencies and cryptocurrency trading, right? Digital currency trading. But as someone who works with lawmakers from tax policy perspective, do you foresee attempts to sort of widen the tax net such that profits that people make from trading digital currencies will be captured by the tax authorities?
Okay, thanks for the question. It's an interesting question. The reality is that the current rules in Nigeria, the current tax regime in Nigeria is broad enough to cover profits derived from currency trading. That's the reality. So if I take, for instance, the Companies Income Tax Act, Section 9 of the Companies Income Tax Act, which is the charging section of the act, is broad enough. It covers any other source of annual profits that are, so there are specific provisions under Section 9, and then there is a broad provision, like an omnibus paragraph somewhere there in Section 9 that tries to cover any other source of profit that is not specifically mentioned. And so where a company, for instance, is involved in crypto business and it is deriving profits therefrom, then that provision would apply to the company. And in any case, if it's a Nigerian company, also bear in mind that Section 13(1) of the Companies Income Tax Act clarifies that a Nigerian company is liable to tax on its profits wherever they are derived from. And so to the extent that what is derived is profit, especially what is derived is profit, not capital gains, for instance, revenue profit, or profit relating to the operations, the regular operations of the company, then the provision of Section 9, provision of Section 13(1) will form the basis for the taxation of that Nigerian company. If you are talking about foreign companies, the question is, does Section 13(2), for instance, also not cover that? If you take the likes of Binance, the likes of Luno, and the other companies involved in even normal stock trading or currency trading, if you take the view that these companies have a sustained interaction with persons in Nigeria, if you take the view that these companies are providing their service through a digital platform, if you take the view that these companies are involved in some form of intermediation service, then those companies also fall within the purview of Section 13(2) and the significant economic presence order in Nigeria. So what I would expect the tax authority to do is to just provide more clarity to those specific companies, to let them know that they are covered by the current tax regime in Nigeria for the taxation of the digital economy, and let them know what the obligations are. And the interesting thing is there are judicial precedents that support the fact that whether the profit you have derived is legal or illegal is not the question when it comes to taxation. So even if you have derived illegal profits, it is still subject to tax if the tax law covers it. So tax law doesn't bother about the morality or the legality of the source. It's the question of, is it profit? If it is profit, is it liable to tax? If it is liable to tax, then that company has an obligation to pay tax. So that's the thing about trading, cryptocurrency trading. If I move to the Capital Gains Tax Act, there is a broad provision that covers, so when you look at chargeable assets, the capital gains tax actually talks, I think in Section 3, talks about the fact that every currency except the Naira is a chargeable asset. And so whether you are talking about Bitcoin or you are talking about Ethereum or you are talking about Doge coin, they are currencies. So if you take the view that they are currencies, then they are chargeable assets. And if you have then derived capital gains from buying Bitcoin at $18,000 and selling it at $50,000, you've derived a chargeable gain under Section 6 of the Capital Gains Tax Act. So and then when people also, maybe, what do you call it now? When they when they essentially fix their digital currencies, because that's also available on the crypto platforms, where maybe you can then get the currency back. You earn some form of interest on a monthly basis or on a weekly basis, and then you can have the currency back in maybe after 30 days or after 180 days. That income is also some form of revenue profits that are derived. So that would also be treated as if it's interest that you are deriving from fixed deposit, for instance, and it will be taxable. Personal Income Tax Act also has broad provisions that cover taxation of income. So I think there's a framework, the current framework for taxation in Nigeria covers profits derived from trading in crypto. But the tax authorities just need to do a better job of education and maybe issuing guidelines so that is clarified. Thank you.
Okay, thank you very much, Akinwani. Thank you very much. I know that there's still the issue from an accounting perspective, right? So yes, you've derived profits or revenue, but it's not legal. So these platforms, even when you're making these payments, you can't use the normal banking channels. You probably have to do P2P, where the purpose of the payment you're making is not clearly stated, right? So how does the tax authority actually determine that the transaction that you've done relates to digital currency? There's also that issue, right? I think that as things develop, right, we'll begin to see a lot of these issues come up practically, and then we'll get the FIRC's take on it. Perhaps those positions will be challenged, like you said, at the tax appeal tribunals. Titilayo, having heard what Akinwale has said, about being aware of what your tax obligations are, right? I know a lot of people would have thought that, oh, if I operate in a certain space, the tax laws are outdated and perhaps do not catch me. They are not wide enough. We've heard that Section 13, Section 9, are wide enough to capture some of these profits that you make that you think that the tax laws do not envisage, right? So for you as a tax practitioner within a tech company, what would you say your role has been? How instrumental have you been to a company like InterSwitch? What would you advise tech companies to do with respect to having some sort of professional tax, either a tax professional, a legal tax professional, advise them on their affairs?
Okay, so thank you. So one thing is the payment industry or the tech industry is fast-paced. So if for any professional, whether tax or whichever specialist, based on your specialization, one is you need to follow the trend in the industry and be aware of issues. So you're typically on your toes, understanding the issues that are affecting the industry. What is the regulator, not necessarily FRS now. CBN could issue a regulation that completely impacts our industry. So how well are we prepared? So what I do in my role, and with the support of my colleagues that support me as well, is we deploy a risk-based approach, and that is ensuring that everything we do, discussing with people in business that actually interact with customers on day-to-day basis is a risk-based approach. This is what the law says, and this is what it should be, so that we don't run foul of the law. Like I mentioned earlier, InterSwitch is a compliant company that I pride myself to say there is nothing, even going to the tax authorities. I've said it several times to say you cannot run us foul of the law. The only where there might be differences is where there are different interpretations to how we've treated and how you think it should be. So that's the way InterSwitch is played. And our compliance rating is also high because we ensure constant review of compliance across all the entities within the group, whether in Nigeria or outside of Nigeria. And maybe another thing that has probably helped me pay well, aside the wealth of knowledge and my technical skills, is also the interpersonal skills within the industry. So something is coming up today, I heard of something or I read something online. There are a couple of people I could call. You could be within my industry, you could be in consulting, or somebody in FRS, and I'm saying, oh, I heard this. What are you guys doing? Have you thought of this? Have you thought of that? So I think that interpersonal skills also helps you. So it's not like, oh, you just wait on your role, the FRS issues something and you are completely not aware of what is happening. And it's until when it is issued and you are then saying, oh, this is the impact. It takes a while. Meanwhile, things have happened, proud to that time. So I think, touching base and maintaining relationship, across the industry, consultants and also regulators, helps in managing tax affairs. And then maybe for any tax professional that's probably, within the industry, and what do I think, companies should do? Typically, proud to now, you find companies, the companies actually think, why should I employ a tax person in-house. But as the world is changing, even Nigerian tax space is also changing. It is critical that companies begin to have specialists. And I'm not talking of, I'm just looking for somebody that just left, that just graduated and has, that is qualified. And, you need that industry knowledge that gives you the edge. Then obviously with the support of, a strong consultant that you work with also would help, companies, better manage their tax affairs, because you need, for reputational issue, you don't want, I think the FRS has even reduced, all that in recent times, whereby they go to complaints and they're pasting, non-compliant. If the FRS, they can wake up to it if they think they are not meeting their revenue. If few months down the line, they think they're not meeting their revenue, it's just an instruction and you see them going around with videos and all that. And as a multinational company or even a tech company with, I keep saying, with a future that I am expecting an investor. And the investor you're expecting might not be a Nigerian investor. They are foreign investors. So you don't want, you want a good public image. So it's important to ensure compliance. You probably get a very good professional with the support of, strong consultants also to help manage tax affairs.
Thank you very much, Tilayo. I think we've had a very good and robust conversation. I'll just take one or two questions that we've gotten from the audience. And this one goes to Akinwale. The question here is whether the SCP order has addressed the issue around GAFA tax being proposed under the auspices of the OECD.
Well, I don't think it has. Let me set the context. So when you look at this significant economic presence order and you look at the terms that are used therein, things like sustained interaction, digital platform, intermediation service, and things like that, the general framework for the significant economic presence order was based on the Pillar 1 approach that was being contemplated by the OECD under the BEPS Action 1. And Nigeria also took some time before it eventually issued the significant economic presence order in 2020. But since then, there have been other developments. So there have been revisions to the approach being considered. There was a submission by the OECD late last year. There have been comments by other bodies, the ATAF, and recently the developments that came out of the G7 meeting. So there have been other developments in that regard, and I think the tax authorities in Nigeria are studying the developments and actively following them, and they're also contributing to those policy debates. And eventually, I think what Nigeria has done is to take this unilateral measure, and Nigeria then intends to wait until there's clarity on the globally accepted framework. Once there's cohesion, once there's alignment of all parties, of all countries on the model for the taxation of digital service providers, then Nigeria would adopt that model. So you may then see a situation where at that point, there will be amendments to the Companies Income Tax Act to reflect whatever the realities agreed are, and there would maybe there will be an order issued. So if at the end of the day, the direction of travel is not significant economic presence, maybe it is digital services tax as a different tax type altogether, I believe that Nigeria would seek to adopt that to the extent that there is global buy-in for that kind of arrangement. So the order doesn't currently align with the new developments from the OECD, but it is something that provides some level of certainty on the direction that Nigeria has decided to take, and it will be updated when there's global consensus on the basis for taxing digital companies.
Okay, thank you. So the last question we'll be taking is for Titilayo. So Roland wants to know if there's a practical distinction between taxation of the digital economy and taxation of digital services.
So obviously, the digital services is embedded in digital economy. So if we're going to strip the digital economy is then to say, what are the activities within this economy? Or should I say, what are the activities within this industry? So I think the digital economy is just, the umbrella for the industry. But then the industry, there are different players. What I do is different from what you do. It could be that what I do is an input or an output to what you do. So the digital services are basically what we are speaking to say the tax authorities and globally should focus on how do we tax these services, not just taking it as a one cap fit or to say, okay, digital economy. But then is you need to ensure that you have all the services within this industry and the economy within the ambit of the law is you need to understand and have a full view of what are the services that are covered within this industry. So once the services are identified and understood how the incomes are earned or and once you understand how the incomes are earned, you'll be able to understand who should I chase for certain type of taxes. So that's so there's a distinction in that. Thank you.
Okay. Thank you very much. Because of time, I think one more question, but I mean, in the interest of time, we'll end it here. I know we've had a very wonderful conversation. The panelists have, been they've provided very useful information across board. So I know that for the tech startups, we've learned a lot from this session, and for the tax authorities as well. We've heard some feedback from the industry participants and then from the legal practitioners as well. I would say thank you very much for spending time with us. That's to the panelists. Thank you for sharing your very, very useful knowledge and industry insights as well. We hope to have you here for future tax conversations. So I'll just say thank you very much. I think we've done very well within the time that we have. I'll just hand over to my colleague Tim Lulua, who will just wrap up the webinar generally.
Okay. Thank you, Trudy. And once again, thank you to our panelists for today. Thank you for enlightening us on taxation of digital economy. I personally have learned so much, and I hope that every other attendee has also learned from this webinar. And you also want to use the opportunity to say thank you to our attendees. Thank you for attending. Thank you for taking our time to listen and stay till the end. We look forward to having you at our next webinar where we discuss another interesting topical issue. Bye and see you next time. Thank you.